Hi everyone. Well, Bank of America says buy these 16 battered tech stocks that will turn strong cash flow to the upside. Do any of them make my approved filtered list? I'm afraid not. You see here, I'll move my picture out of the way. They've got Seagate. Well, how did they choose these battered stocks? They looked at free cash flow. Okay, they look at free cash flow. You can see it there. Over enterprise value. Enterprise value, you could argue, is the whole value of a company, which includes its debts. And free cash flow is cash after all encumbrances, as it were. Now, it's one way of measuring a company. It's probably not the simplest, but I'm sure there's an argument for saying that these are companies which have a lot of cash compared to their valuations, and therefore their valuations may well rise. It's a good argument. They don't, however, these companies, I'm not saying they're necessarily bad. What I'm saying is, whilst they're good companies, they don't make my approved filtered list, which looks at both valuations based on earnings, discount cash flows, does look at cash flows, does look at revenue growth, does look at earnings growth, does look at volatility. So it looks at a lot more factors. And some of these were previously on my approved filtered list, and that's fine. We hold for 12 months, see what happens, and then exit. If any drop 25% from the peak, we'd exit. So they may well have been fine 2 years ago. Teradyne, I remember 2 years ago, Teradyne was Applied Materials, Lam Research, Qualcomm, but that can change. It can change because, for instance, a company could become overvalued, it rises, or markets change and cash flows diminish. So none of these are any longer on my approved filtered list. Now, that could mean that my approach is wrong, could mean their approach is wrong. It could mean that we're looking at different things. I'm looking at very stringent rules. They're not. So give you some more names which they mention. Now, I remember advanced micro devices, and here's a classic example of why 12 months I think is a better time period than forever. Imagine this. Okay, so great run up in 2021. Okay, once it dropped 25% from its peak, we had to get out. And thankfully so, because it continued falling. That's why we have the trailing stop. That's why we have a 12-month holding period. Now, if you're a weak holder, also known as risk averse, you might not have waited for a 25% drop. You might have said after a 10% drop, you'll get out. You see the differences there. Okay. If you want more free educational tools as part of my campaign to teach 1 million people how to be better investors, just go there. There's the link. alpeshpatel.com/links. If you're more interested on the trading side of things, then you want to go to pipspredator.com. Okay, my campaign for 1 million, campaignfor1million.com, teach 1 million people how to be better investors. And on the exact opposite end, come to Spain. I won't be teaching 1 million people how to be better investors. I'll be closer to teaching 10 people over 2 intense days, including dinner. We'll have lunch together, we'll have coffees and so on trading and investing and absolutely everything that I know in that period. It's a good way of, if you've not had the chance to really knuckle down on this and you think, you know what, I'm never going to get time unless I take some time out, join me out there and we'll do it together and we'll get you right up to speed. Okay, thank you very much. And don't forget all the likes and the hugs and everything else you're supposed to do.